What is going on, guys, and welcome to the video. I think one of my favorite things on Wall Street is their ability to not only tell me what to do, but also to let me know how to do it and to totally benefit them and screw myself, and they're pretty blatant about it, and that is what we are covering today. They do it openly to our faces, and yet we can still fall into the trap if we're not careful. So I will show you exactly what I mean in this video with actual evidence. I just ask in exchange for you to gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. And we are still sitting at 35% of you guys that watch me regularly that still aren't subscribed. So give it a quick check down there along with turning on all the notifications so you don't miss my videos, because yes, YouTube is dumb and being subscribed is not enough to see my videos, unfortunately. So let's pull up this video right here and see the deception and how Wall Street openly leaks this information to everyone, and it's not in your best interest. Trust me on this one, guys.
What are we doing to measure some of the retail investors maybe not buying the dip or using some of the big rallies to get out of this market?
Yeah, so there are lots of different ways to measure this, obviously. This JP Morgan report was really interesting, showing the fastest pace of exits from single stocks since March 2020. We've also been seeing some of that in terms of the flows from ETFs.
All right, so let's stop it right there. What she said right there and what we saw according to the graphic right there was the largest retail exit since March of 2020 has held true for as long as I can remember in my 20 plus years of investing and doing this. Retail exiting en masse at the absolute worst time. I mean, if you left the market in March of 2020, that was the bottom of the illness crash right there. And you saw the same thing in March of 2009, and we're seeing it right now too, apparently. Does that mean we are at the bottom and this is that final capitulation event before the market makes a bottom and rockets back up? Well, we saw the largest retail exit since March of 2020 in June as well before we made these new lows now. And although some retail names have made new lows, others are sitting up 40%, 60%, some have even doubled up off the bottom, so it's not a universal low, just a low for the indexes themselves, which I don't buy indexes, so it doesn't matter to me. But I just wanted to point this out to you guys as something to watch, and how all the analysts seem to fail to mention that was the bottom. But that leads me to this next section here that clearly shows them clearly leading you to the edge and basically encouraging you to jumping off the edge.
It all sort of comes back to the fact that this market has been so volatile recently. I mean, looking at last week, the S&P falling about 3%, and then two really significant rallies on Monday and Tuesday, and then down slightly Wednesday and down slightly again today. And for retail investors especially, this is a big change from what they're used to, stocks going straight up during the pandemic. And a lot are getting scared and are not quite sure what to do.
Some of them, though, savvier than most, willing, perhaps more risk tolerant than most, are willing to short this market. And that's something you've been writing about a lot as well.
So they just said retail was bailing just like in March of 2020 when the market was at its worst. And now they are saying we are now shorting the market when it's at another bottom, which the time to short the market was when the market was red hot, not after we have such a huge move down and are essentially in the middle of a crash. I'm really hoping you are seeing how blatant they are with giving you guys bad ideas about how to do stupid things that benefit Wall Street. Retail needs to get out because the crash is so strong and it's not 2020 anymore where everything goes up. And then those select few who want to take on risk and invest, make sure you short the market as it makes new lows. Essentially the exact opposite of what you should do in this exact scenario. I literally cannot think of a worse idea on how to play this.
Yes, it's definitely a risky maneuver, but we've seen a lot of interest in taking short positions, either on single stocks. I've also seen some investors pile into inverse ETFs, which effectively deliver the inverse of a popular index. So, the inverse of the NASDAQ, or even 3 times the inverse of the NASDAQ. They're pretty dangerous tools, but some retail investors are turning to those. For professional investors, a lot of times this is a positive sign. When retail exits, that's sometimes seen as a sign that maybe the rally or the downfall is coming to an end soon.
More reinforcement that it's an option, and I will give her credit here for at least acknowledging that it is risky. But here is where they are telling you the truth and flaunting the facts right in front of you. After all that wonderful suggestive discussion on getting out and shorting, They then are blatant enough to tell you that Wall Street sees it as a good sign that the market may be nearing the bottom because retail is out and maybe now shorting the market. Literally, the pigs going to slaughter is what's happening.
Are you seeing that full out washout capitulation outside just the retail investor as well when you're looking at signals for this market?
Looking at this, it's definitely retail investors that are leading the exodus, but also seeing some professional investors as well. Outflows in ETFs, outflows from some of the single stock positions.
Really? So you were just reinforcing the fact that retail needs to get out because even some big money is getting out because of ETF outflows, which may or may not actually be big money. And plenty of people I know have pulled money out of ETFs or retirement accounts, so that may still be a large chunk of retail doing it. But either way, this further drives the nail home that you need to get out because it's not just retail, but it's the Wall Street guys and the smart money too. They're the ones jumping out too. Kind of see how they're kind of deceiving you there and kind of what's going on with that?
So, what everyone's looking at right now is what the Fed is going to do. A lot of this market, I think, is sentiment driven based off of that, based off of the economic data. Tomorrow we get jobs data for last month, which is going to be a big thing to watch. So it's very much a knee-jerk reaction kind of market, and we're seeing these very big swings based off of whatever news comes in.
All right, and guess what, guys? The market has always swung on news and anything else under the sun because they want volatility to make more money and to trade more. That's a fact of life in the stock market, and it has been forever. I know I seemed a bit cynical in this video. I apologize, and you guys know I don't play around in conspiracies or any of the other garbage that is out there on YouTube, basically having people believe that a stock that is worth $5 can somehow go to $100,000 on some crazy theory. And that also means it has a market cap larger than the entire stock market because, reasons. And they are not even realistic at the slightest bit at all. But I have watched Wall Street do what we just watched specifically time and time again. Guys like Cramer will occasionally admit on air that the people that come to the various shows on the network he works for are routinely giving advice that only benefits them personally, and they are essentially trading their book on TV. And yes, he actually admits to that all the time if you're really paying attention. And they always target the little guys, guys like us, the small folks in the market. Do you really think the guys at Goldman are sitting around waiting for this lady's opinion on what to do with their positions, or for Cramer to give you his opinion, or any other YouTuber for that matter, or anybody else? No, they are only looking after themselves and what their strategy is and what benefits them the most. That is it. And that is exactly why I tell you guys not to buy ticker symbol services, but instead to learn how to create a plan, do a proper valuation, set goals, listen to earnings calls, and not the media and all that other stuff like that. Because that is exactly what the actual pros do. That's what Warren Buffett does, that's what Peter Lynch does, and that is what all the great investors do. So I basically figured, why not follow them instead of people like we watch today on the TV? And I have no idea what their intentions are. It doesn't matter. The point is, it's not helpful to me in the least. Anyways, I really wanted you guys to understand this and not fall forward and understand what you are watching when you watch any of these shows or any of these YouTubers or anybody else. I don't think they're worth watching, but that's just my opinion. And if you are going to consider watching, just understand what you're watching and the why and kind of take out the little nuggets that are in there at times and basically ignore the rest. So hopefully this was helpful. And if you don't know how to get a price target or how to do a valuation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.